Because FedEx is in the business of shipping products around the world and domestically, its information it provides to investors is more than just information about its own business. It's also information about the broader macro economy, about trade, and especially as President Donald Trump has increased trade barriers, increasing tariffs, investors really need to digest the results from FedEx to understand the implications of trade policy and how it's impacting worldwide economic activity. So FedEx's most recent earnings call transcript with Wall Street Analyst, I think is a must read or at least a must watch for stock market investors. I'm going to share with you the biggest details that you need to know about and the implications it could have for the broader economy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So FedEx management team said that for both of its segments, a better than expected May more than offset a softer than expected April. And so let's zoom out a little bit and understand what this means coming from FedEx. April, of course, is when President Donald Trump announced the huge increases in tariffs on all of the United States trading partners. And understandably, many businesses paused or extended ordering products and bringing products in. And so that created a slowdown in economic activity, a sharp contraction in economic activity in April. But thankfully, May recovered. In May, uh, the company saying that they more than offset the declines from April. So it was like all of that pent up demand from April extended into May and even more so. And you can understand the reasons for that as well. Remember, President Donald Trump announced those huge tariff increases in April. And then after the administration noticed how sharply economic activity was contracting, they paused the tariffs. And so in May, businesses that were looking at these tariffs and noticing that the new deadline was set on July, uh, they were saying to themselves, hey, let's get all our products in to the United States as quickly as possible to pay these lower tariffs right now. And that way we have the inventory on hand. And so after the deadline, we have some inventory available to sell to our customers and we can have more time to digest the implications of these new policies before we have to make new orders for new inventory, and it'll put us in a better position. So inventories built up in May, orders built up, and FedEx here giving another point of evidence suggesting that trend. They also said they saw 6% volume growth across their U.S. domestic parcel service, but from an international perspective, their volume trends closely track global trade headlines. So it's surprising to me that they saw 6% volume growth in their US domestic business in their most recently completed quarter, which for FedEx was Q4 2025. We saw a slowdown in economic activity in the US in the first quarter and the second quarter of 2025 as these trade policies started to take effect. So FedEx said that following the April 2nd tariff announcement, customer concerns increased and as a result, volume softened. And in early May, upon the tariff implementation, China to US volumes deteriorated sharply and remained weak throughout the rest of the quarter. Interesting. So, China to US volume has broader implications than just FedEx, right? So many companies rely on the Chinese manufacturing establishment to import and outsource their manufacturing to China. These are companies like Walmart, like Amazon, like Apple, and there are more that rely on China as a as a manufacturing base for their supply chains and then importing them to the United States. So this has implications for companies like Walmart and Amazon and Apple, which have told investors that they're shifting production outside of China and also the products that they're manufacturing in China, they're shipping to other parts of the world and not to the United States. So the China to US volume deteriorated sharply. That goes to show those strategies are now being executed by companies like Walmart, Amazon, and Apple. They are now doing what they said they were going to do after the president announced those tariffs. So they're taking their manufactured supply in China and sending it to other parts of the world. And then they're taking their manufactured products from other parts of the world and trying to increase it. Increase manufacturing in India, increase manufacturing in Japan and South Korea and other parts of the world to offset that decline in inventory from China. Overall, China is most companies' lowest cost production facility, right? The only reason they have facilities outside of China is for diversification purposes, for moments like today, for moments like right now, when China is under threat of significantly higher tariffs. Businesses created these supply chains in India and in other parts of Southeast Asia to offset this risk. And right now, they're thanking their gods for having created that supply chain diversity outside of China, but it's still a higher cost manufacturing base. China is well known to be the lowest cost manufacturing base for all of these companies. So now shifting production outside of China, it's going to mean higher costs for these businesses. So within their freight segments, shipments remained pressured, but the year-over-year declines moderated sequentially, with average daily shipments down 1% year-over-year in Q4, compared to being down 5% in Q3 and down 8% in Q2. Average daily shipments are up 8.3% sequentially, was their greatest Q4 over Q3 increase since fiscal year 2021. So they are seeing improvements in the declines of their business because zooming out a little bit, even beyond the most recent threat to their business from the tariffs, consumer behavior coming out of the economic reopening was shifting, buying more services and spending less money on goods. And so that was a big headwind for FedEx's business even coming into this quarter where tariffs were introduced. And then on top of that, now they have tariffs. But at least that other trend, that worsening trend was improving with consumer behavior, spending more balance in terms of their spending behavior, goods versus services. But it's my prediction that consumer behavior is going to now shift again more towards services and less towards goods because of these tariffs. It's going to cost consumers a lot more to buy these things that they're used to buying. And so when they shop, when they comparison shop, and they're, sitting down and doing their monthly budget and they're realizing, man, look at how much we're spending on these goods. Instead of spending money on these goods, we can spend more money on these services, like maybe adding an additional streaming subscription, or maybe adding an additional visit to the barbershop, or adding an additional trip to a local coffee shop or restaurant, all of which is going to be comparatively more attractive than spending money on goods because the cost of goods are increasing and increasing at an increasing rate as we enter the back half of this year and the start of 2026. By the way, this document, the highlighted document I'm reading, is the company's Q4 2025 earnings call transcript. I have this highlighted document available for channel members. If you are not already a member, you can join using the description. I have FedEx as well as many other companies available, and I add to this folder almost every day with a new company or a couple of new companies' highlighted transcript for your informational purposes. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.